Hello everyone, Kieran King here. Today I'm going to be talking about the balance sheet. The balance sheet is one of three key financial statements used to evaluate the financial health of a company or a business, the other two being the cash flow statement and the income statement or P&L. Firstly, I want you to think of a balance sheet as a snapshot of a company within an exact particular moment in time. They're usually prepared every year. It does not tell you the story of a business's financial situation month on month like an income statement or a cash flow statement does. It simply says that at this point in time or at the end of this year, this company has X in assets and owes Y in liabilities. So what makes up a balance sheet? First of all, we have assets. All right, so this is one of the components of a balance sheet. An asset is what a company has. It's what a company possesses. For example, cash in the bank, equipment, property. Okay, this is what a company actually has. Then we have liabilities. Liabilities are what a company owes. For example, a company might owe suppliers for items purchased on credit, or might have debt towards a bank for a bank loan that it took out. That is, anything it owes is a liability. You then have something called shareholders' equity. Shareholders' equity. Okay, shareholders' equity is the last component of the balance sheet, and it's essentially how everything has been paid for, i.e. what shareholders have invested into a company. As you can see from the way I've drawn this out, okay, assets needs to equal liabilities plus equity. Okay, so this side of the equation needs to equal that plus that, and both sides in essence balance. Okay, so that's why it's called a balance sheet. All right, so if assets is 100 grand, liabilities and shareholders equity together must be 100 grand. Okay, if you're still confused, don't worry, I'm going to go through an example right now for you all. So let's say that you and your friend, you want to start a company. You both invest £5,000 into it, and so your total investment is £10,000 for 100% of the company. What happens then is that the company now has £10,000 of assets in it because you've invested that money into it. Assets, it has 10k. All right, we're going to forget about liabilities for now and go straight to shareholders' equity. Because you've invested £10,000 into this business, your shareholders' equity is in fact £10,000. All right, these two sides of the equation balance, they're equal to each other, easy. Let's add liabilities into the mix now. Let's say, all right, in order to, I'm just going to move this title up a tad. All right, so let's say that in order to kickstart the business even more, you go to the bank and the bank gives you £5,000. Okay, let's forget about interest payments for now, but it gives you £5,000 that you need to pay back. That £5,000 now is added to your assets. Okay, so you've got 5k more because of that £5,000. However, at the same time, you now owe the bank £5,000 of liabilities. So as you can see, both sides of this equation now balance. All right, 5 and 10 is 15. 5 and 10 is 15. All right, so you've got 15k on both sides. Okay, this is balance. Now let's spice it up again. Let's say in year one you turn a profit of £10,000. You want to keep £5,000 in the business, but you pay out half of that. So you pay out £5,000 in the form of a dividend to you and your partner. Okay, so 2,500 each. Okay, this means that you have £5,000 left within the business, and there is a little name we give this if it's left in the business, and we call that retained earnings. Okay, it's part of shareholders' equity, and you've essentially left £5,000 within that business. Because you have left £5,000 within that business, you have essentially £5,000 of assets. in that business more. So looking at it again, this is why it balances. You have 5, 15, 20k of assets on this side. You have 5k of liabilities plus 10, 15, 15k of shareholders' equity. You have 20 on this side. The whole thing balances, and that is what a balance sheet is. Okay, your assets equals your liabilities plus shareholders' equity. That is pretty much, although a very simple overview, exactly what a balance sheet is. I've shown you the three components of a balance sheet and why they need to equal each other. I hope you enjoyed this. Please join me for part 2, where I'm going to dive a lot more in depth into the actual headings within the balance sheet. This is very much just the high level overview. It's just very much a theory. Next session, we're going to get stuck in and also look at a real life example and go through that together. Take care and hope to see you soon.